unlock my video. Can you hear me all right? Perfect. Good morning, everyone. Good afternoon and evening for those in earlier time zones. My name is Livelihoods. I'm a financial sector specialist at the World Bank. I'm very excited to welcome you all to the second edition of a very successful knowledge exchange series that our team launched back in 2021 on strengthening financial resilience in agriculture. This edition focuses on harnessing those solutions for climate resilient livelihoods in the agriculture sector. So we're speaking farmers, but also businesses along the agriculture value chain. If we could move to the next slide, please. Okay, just a very quick one on the structure of the webinar. The webinar is accompanied by a fact sheet that we send out in advance and that remains available after the event. We are hosting in total 4 webinars throughout the series, and these will all host different guest speakers that are drawn from the private sector, the public sector, academia, as we do have in today's session, as well as clients or beneficiaries of disaster risk finance programs in agriculture. Please engage with us, use the Q&A functions to share your questions, your comments, your thoughts. The session will be recorded. Also wanted to highlight that participants have a chance to earn a certificate, and that requires attendance in all the 4 webinars, as well as completion of a very short survey after the webinar. Next slide, please. Just to give you a sense of the upcoming 3 sessions after today, these will happen roughly every 4 to 6 weeks, and they will be focused broadly on evidence. Evidence of the impact of financial products, programs at various levels, micro, meso, and macro. And of course, we will have a deep dive into the latest technologies, fintech, digital tech, risk management technologies that can be harnessed or already being harnessed to strengthen agriculture insurance as well as agriculture finance. Next slide, please. So without wasting much time in today's session, which is on index insurance and the state of global evidence, I would like to welcome Olivier Mahou, the practice manager for the Crisis and Disaster Risk Finance Global Team at the World Bank. Over to you, Olivier.
Thank you, Kelly. Good afternoon, good evening, good morning, wherever you are, and a warm welcome to this series. I'm particularly excited to join this series. Also on a personal note, when I joined the bank about 2 decades ago now, one of the topics I've been assigned to work was on agriculture insurance. So very happy to see, of course, all the progress and the kind of new developments we're going to discuss today. We're also pleased to see multiple government officials, development partners, as well as researchers and academia joining us today. I understand from Latin America, Africa, and South Asia. So great to have you all today on this virtual meeting room. So as mentioned by Kelly, this is the second series of our knowledge exchange on disaster risk finance and agriculture. I think we can all agree that this is very timely, not only in the context of climate change, but also in the context of the fiscal constraints faced by many countries when it comes to financing such programs, and hence the important role of the private sector can play in order to, I would say, to support some of these kind of risks, and the importance of deepening the financial inclusion sector in order to tackle with the financial protection gap. So we all know very well that extreme events are getting more and more frequent, drought, floods, and this does impact the productive assets and ultimately will result in widening the poverty traps and also increasing the food insecurity. You may have heard about FAO numbers. From 2008 to 2018, more than $100 billion have been lost in crops and livestock just because of natural disasters. And we also see a growing role of the financial inclusion in order to improve the resilience of the farmers and the rural economies and the entire value chain when it comes to agriculture. So in that context, there is definitely a role for disaster risk finance in order to increase the resilience of rural households and agribusinesses. And in that context, the World Bank has been responding to growing demands of our clients when it comes to providing technical and operational capacity to improve financial services and technical services related to agriculture. So we have developed a series of advisory services, technical assistance, leading to policy reforms and ultimately investments, again, in order to strengthen the resilience of ultimately the farmers, and particularly the poor and marginal farmers disproportionately affected by disasters. And a recent example you may be aware of is the project the bank is leading in the Horn of Africa, called the De-risking, Inclusion and Value Enhancements of Pastoral Economies, the DRIVE project. It's a $400 million project over 5 years, aiming to increase the resilience of pastoralists in countries like Kenya, Ethiopia, and Djibouti. And I think as far as we speak now, I think more than 180,000 pastoralists have enrolled in this financial package, which does not only include insurance and parametric insurance, but also access to savings and ultimately access to credit. And I think this is a topic we're going to discuss, really to think about insurance as part of a kind of comprehensive financial package, including other types of financial solutions. Now, having said that, as we just said, disaster risk finance solutions tend to be quite innovative, new, and to some extent risky. And it's very important for us at the World Bank to be able to evaluate their development outcome and impact. So we do put a particularly focus on impact evaluation done by independent experts in order to help us learn from our success, but also from our failures. So this is still work in progress. And I think colleagues later on will elaborate on that one, but in the context of the DRIVE project as just mentioned, in fact, we are planning to start a pretty significant impact evaluation project, again, to make sure that we can learn from our mistakes and also from our successes. So going back to this series, which built on the previous series as mentioned by Kelile, it's very important for us to organize those series in order to respond to kind of growing needs of our government clients in Africa, in Asia. I can mention India, Philippines, Morocco. We want to know how, to some extent, to strengthen, to improve, to deepen those insurance and financial solutions for agriculture, whether it is developing risk pools, specific products, reserves, the fiscal impacts. And as we all know, this topic does touch into many topics, and it's very important to have this kind of comprehensive, holistic view when it comes to design solutions to ultimately help most vulnerable farmers and also commercial farmers. From what I can recall, the first series of this program had a solid knowledge exchange platform for policy makers and practitioners, and we have reached over 1,000 people. No, 1,000 people, not 100,000. 1,000 people. We'll reach 100,000 people later. And definitely, we developed a large set of learning materials, and Kelly mentioned it. So we do see this event not as a one-off, but very much as a series, learning, not only for us, but also hopefully also you're going to learn from your own experience and try to come up with this kind of learning journey together we can take in order to improve our respective knowledge and hopefully exchange our own experiences. So I'm very happy to see a fantastic and well-renowned set of speakers talking today. Chris Barrett, Caroline Morsick, which has just learned. I got her tenure a week ago. So congratulations, Caroline, again, and Professor Michael Carter. So very happy to have all those distinguished guests today to share their experience. And please do feel free to be a bit provocative here. Please do share with us your honest view on what the World Bank is doing, what one would do best in order to help our clients. I really also, and I will finish on that note, I really want to thank the fantastic role played by Lara today, and together with the USAID. You've been with us now since 2015, so 8 years ago. So it's been a long partnership. hopefully a fruitful partnership. So we very appreciate and acknowledge your continued support in this topic, which now looks obvious, but years ago, as you may recall, when we had our earlier conversations, was a kind of new topic. So it was we were very happy to have you as a kind of first mover in this agenda. And since then, you always provided your generous support and long-term support to this agenda. So let me stop here. Again, wishing you a very successful, fruitful, and I would say provocative thoughts today. And please do engage. I guess we're going to have opportunities to exchange by chats, but please do share your experience. We do need operational experience, technical experience, more academic experience to make sure that this agenda can move forward and ultimately better protect vulnerable farmers and herders in the most exposed climate vulnerable regions. So on that note, I'm very happy to pass now the floor to Lara Evans to deliver her remarks on behalf of USAID. Over to you, Lara.
Thank you so much. Good morning, good afternoon, or evening, depending on where you're joining us from. As Olivia said, my name is Lara Evans. I am a social protection advisor based in USAID's Center for Resilience and the Bureau for Resilience and Food Security. You might be asking yourself, why is a social protection advisor providing opening remarks at a disaster risk financing for agriculture webinar? Well, the answer is simple. USAID views social protection as an essential disaster risk financing tool, along with other instruments such as index-based insurance, which we'll be talking about today. The negative impacts, social and economic, of the COVID-19 pandemic brought to the forefront the need to protect people in times of shock through large and established risk management tools, such as national social protection systems. This increased attention and investment in disaster risk financing tools, such as social protection systems and agricultural insurance, has continued in light of the increase of food, fuel, and fertilizer prices, along with inflation, market instability, and growing poverty. Social protection, like insurance, is a key policy instrument to manage social and economic risks, as well as strengthen countries' preparedness and response to multivariate shocks and stresses, maintaining food security, fostering adaptive and resilient livelihoods, and reducing the ultimate cost and impact of shocks and stresses. As Olivier mentioned in his remarks, financial inclusion is crucial to improve the resilience of farmers and rural economies in the face of climate change. We all know that climate change is increasing. It's increasing poverty for vulnerable groups, such as smallholder farmers, as well as decreasing overall well-being across the non-poor and affecting societies as a whole. Social protection can play a central role in managing climate risks by addressing chronic poverty, providing temporary support during periods of acute economic and livelihood disruption. This is why USAID views social protection as a key component of comprehensive risk management and risk financing strategies. As we learned in the first series, John-Luc Plevin gave us a discussion around risk layering. No single disaster risk financing tool can address all risks. Tools need to be tailored for the severity and frequency of the hazard and layered onto one another in order to provide maximum protection. So as we see it, the linchpin, or the essential ingredient for financial resilience, are comprehensive risk management and risk financing strategies. Prearranged financing, such as an insurance payout, can mitigate negative coping mechanisms like reduced food consumption, livestock death, and distressed sales of productive assets. When individuals, households, and communities and governments are able to identify their risk exposure, to plan and prepare for how to manage and finance those risks, negative impacts are lessened and resilient outcomes are improved. Therefore, disaster risk financing, including index-based insurance and shock-responsive social protection, are fundamentally required to meet the challenges of the 21st century and the challenges that we're experiencing today. And Olivia acknowledged that USAID has sort of been in this space since 2015. And I'll just say, you know, we work in close partnership with the World Bank, the African Development Bank, African Risk Capacity, as well as academic partners such as Michael Carter, who's here today, investing in these risk pools, looking at sovereign level, index-based insurance, looking at meso and micro levels, looking at quality certification of these products. So really, just in the face of extreme shocks and increasing vulnerability and uncertainty, financial resilience is so important. And looking at anticipatory action and the best ways that we can meet the needs of the populations that we serve is close to our hearts. And we're happy to be here today. So thank you so much. I'll turn it back to you, Q.
Thank you so much, Lara. And thank you, Olivia, again, for those very comprehensive welcome remarks. I hope everyone in the room feels welcome and has had a chance to grab coffee, tea, or whatever drink of choice is appropriate for this occasion. So before we hand over to our guest speakers for today, I will do a very quick recap of part one and highlight 3 key messages. Next slide, please. So as you'll see, part one really covered in a very comprehensive range of topics, and it also went to a lot of great depth on each of these topics, from the role of disaster risk finance within the broader risk management framework, the right instruments, the data that's required, how to use it, as well as how to structure financial protection schemes, and more importantly, the role of government. So all of this material is publicly available on our website, the Financial Protection Forum. And I must recognize my colleague, John Plevin, who led this part one series and laid this incredible foundation that we're building on today. Next slide, please. So the first key message from part one is that there really is a wide range of market-based solutions that correspond to different levels of risk, as well as different segments of farmers. Next slide, please. And these solutions should and can complement informal mechanisms, and they are more effective, of course, in building resilience to shocks, as the opening remarks have highlighted very strongly, when they're part of a comprehensive risk management strategy. At the catastrophic layer, indeed, market-based solutions are very helpful at reducing reliance on harmful coping strategies, which Lara touched on in her opening remarks right now. Next slide, please. I think we've heard this before. Lara also touched on it. It really does require a range of financial solutions depending on the risk profile and needs of farmers, integrated all the way from payments and savings to a more tertiary level, including insurance. Next slide, please. The second key message that we wanted to highlight is that we've seen digital technologies as one of the key enablers to evolving agriculture insurance and enabling index-based insurance, which has made insurance more affordable and accessible to low-income segments of the population. However, we find that basis risk still remains a challenge. Next slide, and just to touch on what we mean by index insurance and indemnity insurance. I suspect a lot of us in the room are already familiar with what index insurance is, but just to highlight that this is a relatively new product compared to traditional or indemnity insurance, which is centuries old. Index insurance, roughly 30 years or so old, so it's a young kid. This index pays out based on a trigger or an index that is designed to be highly correlated with the actual loss or damage, but it is not based on the actual loss or damage. The indices, there's a range of indices that could be used depending on the peril, depending on the priorities. This range from weather-based indices, could include vegetation indices, or actually the average area yield in a space. What an index does is that it removes the need for field inspection in agriculture insurance. That helps ensure a fast payout relative to indemnity, which would require a loss assessor to visit the field, assess the damage, and quantify the loss. By so doing, it also makes insurance more affordable. A big part of the cost to insurance companies for agriculture index is the loss assessments that have to be done. So once those are avoided due to the index, the costs become lower and hence more accessible. There's more material on this available, as we highlighted in the Financial Protection Forum. Next slide, please. So while index insurance has helped really address major challenges with indemnity insurance, like the high costs, like information asymmetries, the fact that the relationship between the actual loss and the index is imperfect can create significant basis risk for farmers. So just to depict this, if we were considering, for example, an excess rainfall cover, where a threshold is set to correspond with the level historically beyond which farmers start to experience losses. If the threshold is reached for just the areas that we highlighted on that slide, the other areas would not get a payout. Only the areas in yellow would get a payout. Next slide, please. However, even within those yellow areas, you do find that in some cases, there are microclimates and many other reasons that might lead to the threshold not being met. And this creates basis risk. And both downside basis risk and upside basis risk are problematic. Downside basis risk is whereby a farmer experiences a loss, but the index does not trigger a payout. What that means is that the farmer is worse off than the condition they were before purchasing the insurance. Equally, upside basis risk is problematic for insurers because it means that the insured then profits from the insurance. They did not suffer a loss or experience a loss, but the index triggers a payout. So both are problematic, and we're excited to hear about solutions and thoughts around addressing this as agriculture insurance continues to grow. Next slide, please. The third key message is that we have learned that from international experience that delivering these solutions at scale does require public-private partnerships to address market failures in an effective and sustainable way. Next slide, please. While governments can play a whole range of roles from technical to financial, as highlighted in the slide, with more information available in the Financial Protection Forum, what we found is that premium subsidies are the most common public intervention, and that applies in both developed countries and developing countries. So we'll be learning a little bit more about the impact of subsidies and programs from our panel of speakers this morning. Next slide, please. All right. I think the link will be posted to the previous webinar series and material. Please feel free to scan that. Reach out to us if you've got additional topics that you're interested in for this webinar, as well as further series that we're working on. With that, I will invite our first panelist for the session. Next slide, please. Over to you, Chris.
Thank you very much, Kalile, and thank you to Olivier and Kalile and Ansu and the whole World Bank team for organizing this very exciting event today. It's a real honor and pleasure to get to share the discussion with them and Lara and Michael Carter and Caroline Morsink. And greetings to all who are joining. You know, it's interesting when one is asked to give a brief talk on the origins of something, it means you've officially become an elder, because one goes to the elders to tell the origin stories, right? So I feel like I'm officially old now. Thank you for this invitation to be officially old to tell the origin stories of index-based livestock insurance, IBLI. Next slide, please. There are several moments that really mark the origins of IBLI. One of them is in early 1995. When a brilliant Ethiopian graduate student, a PhD student in range science named Solomon Desta, walked into my office at Utah State University, and he said, I've been working for the past 15 years among pastoralists in southern Ethiopia, and I've collected these longitudinal herd histories among families, And I and my advisor, a professor named Lane Kopic, are really interested in thinking about how do we better manage drought risk and why are people poor for so long? And Solomon's query set me on a path with a range of very talented collaborators to understand this phenomenon of persistent poverty in the pastoral areas of the arid and semi-arid lands of Kenya and Ethiopia. So that work, Lara, AID's investment in this goes back way beyond 2015. AID supported our original pastoral risk management program in Kenya and Ethiopia, where one of the key discoveries of that work was that, one, poverty traps really exist. Some of you are familiar with Art Cray and David Mackenzie's appropriately celebrated paper on poverty traps, where they identify this area of the world as maybe the place where the evidence on poverty traps is strongest. And those poverty traps, as documented in the lower left graphic, another talented graduate student, Travis Libert, some of us did this work with Solomon's data. That graphic shows you sort of the classic S-shaped recursion diagram, meaning mapping today's state into tomorrow's state, when that shows multiple equilibria might exist. A key thing of multiple equilibria is risk becomes especially salient. In the case of pastoralists, it turns out, work done by another talented graduate student, Paulo Santos, that drought risk really is the driving cause of the existence of poverty traps in the setting, because it causes a massive loss of the productive asset base households enjoy, which reduces their incomes going forward until such time as their herds can recover. But if that loss was big enough, it's driven them into a different sort of production system, away from extensive grazing towards sedentarized production, where the carrying capacity sharply limits their herd accumulation. Moreover, if droughts are happening frequently enough, they don't get time to recover their herds. So catastrophic herd loss due to major droughts turned out to be the major cause of poverty traps existence. So a few of us refer to this as stochastic poverty traps, because the poverty trap really originates from uninsured catastrophic risk exposure. Now, of course, this means that providing some sort of insurance against that drought risk exposure now gains particular salience, becomes especially valuable. Some work Michael Carter and I did with Nobu Ikegami and Sarah Jansen refers to what we call the paradox of social protection. In this kind of an environment, there will always be, in every society, there's some small subpopulation that's inevitably chronically poor due to a host of complicated reasons, oftentimes related to very poor health, cognitive or physical. But there are lots of people who don't have to be poor. But if they cross this threshold, if their productive assets become depleted such that they get cast into destitution, they too need the support of society to maintain an adequate minimal standard of living. And the paradox of social protection is, if you're concerned about these poorest of the poor, the chronically poor who will always need support from the rest of society, then we need to wisely invest in protecting those who don't need to be poor, those who have the ability to support themselves. You need to protect them against catastrophic loss, because the paradox is, if you concentrate all your resources just on the poorest of the poor and you don't provide a safety net for the vulnerable middle class, if you will, then that middle class over time gets thrust into poverty and they join the ranks of those who depend upon the state. And pretty quickly, social protection systems get overwhelmed. So the paradox of social protection is, you need to invest in safety nets for those who don't need support long-term in order to safeguard the well-being of those who will always need some support in steady state. So this is the essence of the case for investing in something like index-based livestock insurance in a system like this, where there clearly are risk-based poverty traps. Next slide, please. So that led us to then think carefully about what's happening in this system. Pastoralism is an evolutionarily refined system. People have migrated animals for millennia to find water and forage. The challenge is that the pace of climate change means that this system cannot adapt fast enough through natural mechanisms. We need to supplement it. And moreover, if drought frequency is increasing, as many fear it is, this is not yet clearly established in this area of Africa, but there's reason to believe based on recent history that the frequency of severe droughts is increasing. Then if droughts are the cause of poverty traps, we might not only have poverty traps of the sort that we documented using Solomon's data so long ago. You could drive this into a system that has completely collapsed. The graphic here comes from work Paulo and I published a number of years ago, where we simulate this system with different frequencies of drought. And what one finds is that if drought risk were cut in half, you get to what I refer to as the West Texas equilibrium, where catastrophic droughts happen in this semi-arid or arid system, but they happen infrequently enough where one can maintain a very large herd size. That's the curve depicted in blue, where there's a unique long-run dynamic equilibrium with a very high herd size, like we see in West Texas in the United States. But conversely, if drought risk doubled from what we had observed historically, so that one moves from the historical average depicted in black to a new, more frequent drought equilibrium depicted in red, then the system collapses in expectation, so that you only have a single low-level equilibrium. So this sort of modeling work, what are the consequences of climate change if we don't change the system, accelerated our interest in developing effective drought risk mitigation interventions like IBLI. Next slide, please. And we needed new interventions because the standard responses to major drought shocks in this region were really two: post-drought restocking, which work Paulo and I did shows is futile. When you transfer one cow to a household that has fallen from 12 cows to 2 or 3, you're not helping it get back onto extensive grazing on the rangelands over time in expectation that herd transfer just gets lost. And the other is food aid, which is a very slow, expensive method. And moreover, it reinforces sedentarization, which is what we're trying to overcome among pastoralists. Because you have point-based distribution, it commonly leads people at the margin to stay in one relatively narrow grazing range. So if we're seeing climate change is causing more frequent drought, greater risk of collapse into poverty traps, and the existing tools just are not fit for purpose in this environment, we can also be in a situation where increasingly sedentarized populations overgraze their local rangelands, just reinforcing the vicious cycle of feedback that creates the poverty trap to begin with. Next slide, please. So the response to this, and this is sort of the next moment of IBLI's origin, is another brilliant graduate student from a middle-income country, Pin Shantarat, showed up in my office with a degree in financial mathematics, keen on thinking about how we can use options pricing to manage risk in the developing world. And we used the data that we had collected in this pastoral risk management program to develop what became IBLI. And the basic design of IBLI is fairly straightforward. We use a satellite signal, the normalized difference vegetation index, collected regularly with high quality satellites, publicly available. It's non-manipulable data. It's near real time. It's frequently available. And Pin's dissertation developed a response function where we could predict livestock mortality based on NDVI signals. And I emphasize we used household loss data. So we were intentionally designing a product to minimize the basis risk Khalile already told us about, and that I believe Michael will speak more about. So we used one data set, longitudinal data set on household livestock mortality, to design a product to minimize basis risk, and found we could predict livestock mortality quite well with the NDVI signal. We then validated this out of sample on a different data set, found that indeed the predictive accuracy of the IBLI response function was quite good. And working with Michael and other partners, we then went to the insurance and reinsurance community to try to develop a partnership. And indeed, in northern Kenya, we could develop a partnership which was originally based off of a predicted 15% loss of livestock herd. So the first risk layer, 15% loss, was absorbed by the insured pastoralist, and the remainder would be reimbursed by the underwriter, supported by reinsurance. And this contract, in this setting where there are 2 rainy seasons per year, had 2 different sales periods per year depicted in the graphic, and then 2 different prospective payoff periods per year. This contract was later adapted, work that another brilliant graduate student, another key moment in the origin story, Nathan Jensen. Nathan led some work helping to redesign the IBLI contract, and it's now a contract that pays off a little earlier. It's based just off of NDVI, not livestock mortality predictions, but the essence of the product is the same. It's insuring against catastrophic livestock loss that originates from observably poor range conditions, which are essentially an indicator of catastrophic drought. Next slide, please. So the next part of the origin story is Michael Carter and another brilliant graduate student, Andrew Mude, a Kenyan who did his PhD with me at Cornell. And he returned to Kenya to work at ILRI, the International Livestock Research Institute. ILRI then became the lead on the IBLI program that Michael and Andrew and Pin and a range of us worked on, where from the beginning, we introduced a very careful research design. The initial product, remember, was in northern Kenya, depicted here in blue. And we set up a sampling design with a randomized premium discount distribution for what's called a randomized encouragement design, that randomly we would encourage people to differing degrees to buy the product so that we could causally identify the effect of IBLI uptake on a range of outcomes. So we did that in Kenya with a very intentional overlay with a new cash transfer program the government was launching at the time, the Hunger Safety Nets program, so that we could run a horse race, if you will. We could compare the impacts of cash transfers with the impacts of IBLI. And not too long thereafter, we launched this product in January of 2010, following baseline surveys in October 2009, October, November 2009. Not long thereafter, in 2011, some of you may recall a catastrophic drought hit the area, and IBLI worked exactly as intended. And we wound up then fielding queries from lots of places that were interested in replicating that Marsabit product that we had piloted in northern Kenya. So we developed an analog, we developed a variant of the same IBLI contract for southern Ethiopia in the adjoining area called Borana. You see that depicted here. That too was with AID support led by the innovation lab that Michael leads. So there too, we use this very similar design. And between these two, with that Borana Ethiopia IBLI product launching in March 2012, following the January 2010 launch of the IBLI product in Kenya, we had a multi-country, carefully designed research structure to be able to evaluate the impacts of IBLI in 2 different settings, 2 different financial systems, 2 different government policy environments, so we could say some fairly general things about IBLI. Next slide, please. I won't go into all the details of the impact evaluation, but let me underscore 2 big points. The first point is that IBLI worked, but it's not a perfect product. There is no perfect product. Kalili emphasized earlier the need for multiple complementary interventions. We found that covariate risk, drought shocks that are hitting everybody, that are affecting everybody, are indeed a major feature of the landscape there, as depicted on the left by plots that show for very specific index insurance areas in northern Kenya, that you had these moments where the average loss rate spiked above the strike level of 15%. But around that shared loss experience in a community, around the covariate loss experience, there was huge variation. And there was variation even within individual households over time. So you had a lot of idiosyncratic risk that necessarily doesn't lend itself to something like index insurance. So IBLI IBLI wound up covering something on the order of, at a very minimum, about 1/4, at a maximum about 40% of the total risk exposure, animal mortality risk exposure households held. They still held most of the risk exposure, underscoring the need for multiple risk layers. But it was effectively removing a big chunk of the catastrophic risk in that system. And we know that most effectively through these evaluations done by Nathan Jensen and Andrew Mude and me, but also, next slide, please, through the impact evaluations. So in spite of IBLI being an incomplete and imperfect product, multiple studies using these data that we collected, panel household survey data we collected in both Kenya and Ethiopia, we could document multiple impacts, indeed multiple impacts that at the margin had dramatically higher benefit cost ratios than the cash transfer programs the government was running in northern Kenya in the same place at the same time. You could see increase in veterinary expenditures indicating that households were more likely to wind up investing in preserving their animals, higher productivity of those animals, higher household incomes, better child mid-upper arm circumference, a key indicator of child survival in times of acute stress. In drought years, you were seeing greater milk production and higher incomes. Work Michael did with Sarah Jansen showed reduced distress sales of livestock, less meal skipping in response to getting indemnity payments. Even when the insurance didn't pay out, in the early years in Ethiopia, there was no payout on insurance. Recall in Kenya, the product paid out in the first complete year. But in Ethiopia, we went several years before payment. But we could see in subjective well-being data that purchasers of insurance felt they were better off whenever they had an insurance contract in force than did otherwise identical people who did not have insurance in force. They regretted having bought insurance once the contract had lapsed and they had no payment, but the effective peace of mind of a contract in force was far greater than the regret, the buyer's remorse effect of a lapsed contract. So in equilibrium, it made sense to be buying index insurance in this setting, even if it wasn't paying off. That's a crucial finding, that people feel better off. People's well-being was enhanced, even if they aren't getting the indemnity payment. And Kalile referred to informal risk management strategies. We also found that IBLI was helping to crowd in more informal transfers. It helped to firm up the fraying social fabric of informal insurance within communities in southern Ethiopia. So the net impact across a range of studies, several of them cited at the bottom of this slide, the impact evaluation evidence from this panel data we collected in both countries was very clear that IBLI worked. It generated consistently positive impacts among a very poor, poverty trap exposed population with at the margin much higher benefits per dollar spent even than cash transfer programs, which are rightly celebrated as very impactful in much of the world. Next slide, please. So that evidence, and this was a next key moment in the origin story of IBLI, that evidence of the high impact of IBLI, especially as compared to a cash transfer program, then really prompted a range of players to begin taking up IBLI and replicating it in other places. So this map shows you the spread of IBLI. Recall from that earlier map where we zoomed in on Kenya and Ethiopia in dark green here, that the areas in which we launched IBLI in those pilots in Marsabit in northern Kenya and in Borana in southern Ethiopia were just a very small bit straddling the border in sort of the north central part of Kenya there. Now, the Kenyan government has taken the program largely nationwide through the Kenya Livestock Insurance Program. The World Food Program uses an IBLI design behind programs it has in both Ethiopia and Zambia. IBLI is behind the sovereign drought risk insurance in Mauritania and Kenya and other places. And as Olivier mentioned at the outset, the DRIVE program that the World Bank is helping to support throughout the Horn of Africa has IBLI as one of its centerpieces. So this origin story from an Ethiopian graduate student walking into my office in 1995 through multiple brilliant graduate students who helped us with the discovery along the way and who helped to not just come up with a clever design based off of minimizing basis risk, but also to establish rigorously that even though this is an imperfect, incomplete coverage of all the risk exposure people face, it has really big positive impacts. That's the story of IBLI to date. This is an exciting new chapter with the launch of DRIVE to see this expanding even further. hopefully we're going to be able to see similar sorts of careful building of evidence and continued improvement of the product, as has been the case with IBLI over the past 13 years. Next slide, please. So with that, I direct people who are interested, all of the data, most of the publications, lots of background information on IBLI is available at the website at the bottom of the URL there, drylandinnovations.com. The key summary here is IBLI is a terrific product. It's not a perfect product. It's a terrific product that really does help with disaster risk management for pastoralists. The evidence on this is very clear. And it's a promising option for helping to address the sorts of poverty traps that afflict regions like the arid and semi-arid lands of northern Kenya and southern Ethiopia, and where climate risk is increasing catastrophic drought risk exposure. And as a community, we need to be really concerned. This is a potentially very high impact, high leverage investment, inviting public-private partnerships. It's been a real privilege to be involved with this over the last 20 several years. And I look forward to witnessing the ongoing evolution of IBLI in the years ahead. Thank you so much. I look forward to the rest of the presentations and the discussion.
Wow, brilliant. Thank you so much, Chris. Very thought-provoking. And again, for the history buffins in the room, I'm sure you enjoyed that as much as I did. Now we'll invite Michael Carter. Over to you, Michael.
Okay, great. Good morning, evening to everyone. It's a great pleasure to join this. As long as we're being history buffs, cue the first index insurance contract celebrated its 102nd birthday this year. So at the end of my slides, I have a list of references if anyone is interested, and we published a paper in Nature Reviews recently. So the first index insurance contract was actually an area yield contract in India in the 19-teens. So we can look into that. But I don't want to make myself feel any older. I could reference when I was sitting in my office, a young puppy named Chris Barrett came in bouncing around with his new ideas, but that would make me feel genuinely ancient, since we've now learned that Chris is a community elder. So let's just jump right into this. I'm going to pick up, I think, very closely on what Chris is talking about. And I want to sort of talk about where we are with index insurance qualities, focusing on livestock insurance, and kind of where we can go. So next slide, please. So at this moment, I have some work in northern Kenya. The women we saw on the cover slide are actually in Samburu County, but we're working with a very innovative company called Takaful Insurance Africa. I know there was a pre-conference discussion about Takaful Insurance. There's actually Takaful Insurance Africa is a great resource for that if anyone is interested. But the CEO of Takaful Insurance came to me and said, a lot of our clients are kind of angry. They feel like they've had losses, they've had these negative basis risk events, and we need to improve the quality. So that's what I want to really talk about with you today. And I hope this is very relevant for the upcoming drive work. I think it's vital that we take seriously what we've done well, what we've done wrong, and more importantly, how can we do better? So the starting point of my comments is, if we want to improve quality, we actually know how to measure it. If a farmer said their maize wasn't good enough, we'd say, well, let me see if I can breed you maize that has better yields or better stress tolerance. We would know what we were talking about and how to measure better, how to measure when we've achieved a better contract. So in the Markets Risk and Resilience Innovation Lab, which is a USAID funded venture that's been deeply involved in this work, as Chris alluded to, for a long time, we've developed what we call an index insurance certification or QUIC program. And the first step in that, in fact, was to define a measure of quality. So if you're going to certify quality, if you're going to design for quality, you need to know what it is you're talking about. You can't just be too impressionistic about it. So we use some basic economic tools about measuring the expected economic well-being of a population facing risk, and we use that to create a quality standard. And we use it in two ways. The first is we define what we call the MQS, or minimum quality standard. So an insurance contract, if it improves the expected level of economic well-being of a person, then we say the contract meets the minimum quality standard. Now that sounds pretty minimal, but it turns out many of the early generation index insurance contracts did not meet that minimum quality standard. They were actually not improving the well-being. Now that's not IBLI, as Chris already alluded to. But the second and perhaps more exciting aspect of quality measurement is that you can use it to design better insurance contracts. So as part of this effort, we've created what we call the RIB, or Relative Insurance Benefit Measure. Now, as Q already told us, we know that sort of conventional loss-adjusted insurance is not feasible. Nonetheless, we are able, if we have data on what's happened to people, such as the IBLI data, if we have data that allow us to observe losses, we can at least simulate what the well-being of a person would have been with perfect insurance. And then we can take an implementable index insurance and ask ourselves, what fraction of that potential insurance benefit is actually achievable? Okay. And so if you have the RIB metric and you're considering different alternative insurance indices, then an obviously way to go forward is pick the one that offers the best relative insurance benefit, or RIB. So that's what I'm going to talk to you a little bit about today. So next slide, please. So I'm going to go back to Marsabit County, Kenya, where all this began with Chris, Andrew Mude, Pinchatarat, and a host of others, as Chris summarized for us. When we talk about improving quality, a lot of us have often focused on what's the index that's being used. For rangelands, for example, we might consider rainfall measures, or we might use the NDVI measures, or we might use evapotranspiration measures, or in the crop world, we might use area yield. There are lots of those kinds of measures. But an equally important element here is actually the definition of the insurance zone. Okay, and I don't think this has been explored carefully enough. One of the papers in a journal called PLOS One, it's referenced at the end of the slides, we actually go through a suite of possible indexes, taking insurance zones as fixed. And what I want to share with you is work we're doing now, which actually we promised Sumaya Hassan of Takaful Insurance Africa that we would do, to see how much could we improve the value of insurance if we design insurance zones in a more scientific way. So I want to talk about doing statistically optimized insurance zones. And again, just to make sure so this doesn't sound too abstract, if, and it was in some of Q's slides actually, if you define an insurance zone, and let's imagine it runs east-west, say for 100 kilometers, if people in the eastern part of that zone have different kind of outcomes than people in the western part of the zone, then one of the others is going to be very unhappy, because the overall zone may not trigger a payment, but if the people in the east have had losses, then they're going to be very unhappy. So the question is, how can we do this better? What I'm going to show for you to give the punchline, if we simply take Marsabit County and we statistically optimize the insurance zone, we can actually double the relative insurance benefit of an existing insurance contract. In fact, we can triple that benefit if we actually expand the number of zones beyond what's currently being used in Kenya. So these are huge numbers that come from simply improving the zones in a way which I'll briefly describe. The second point I want to leave you with, and it's again a major point, even when we optimize the zones, the relative insurance benefit that we can achieve is well under 50%. That means despite all the strong evidence that Chris shared with us, even if we do better than what the current IBLI contracts have been doing, there's still a lot of headspace for improvement. So I want to put forward here, and I think it's an important agenda for action, is we need to embrace that imperfection. We need to say we can do a lot better. And I think until we improve our remote sensing methods, we actually need to look at hybrid audit-based mechanisms, and time permitting, I'll say just a little bit, a tiny bit about that. So let's move on to the next slide, please. So this is Marsabit County. Chris's slides already showed us where that is in northern Kenya. Ethiopia is just off the northern edge of that map. When Chris Pinn, Andrew Mude, and I originally designed this along with some people at ILRI, I went back and I found the original documents. There was a fairly recent former president of my country, the United States, who made a lot of television news when he took a hurricane map and took a magic marker and changed the path of the hurricane. We did something like that. We actually have maps of northern Kenya where we had done magic markers saying, let's make this the insurance zone. And when we first set this up, if we go back to 2009 and 10, when we were putting this together, we actually designed 5 insurance zones in northern Kenya. And we did it by talking to people about agroecology, herd compositions, ethnic fault lines, things that really do matter. But it was sort of ad hoc. Subsequently, those 5 insurance zones were expanded to 14 insurance zones. And the map you have in front of you here shows the existing insurance zones, or UAIs as they're called in Kenya, which have been used for the Kenya livestock insurance program. So the question I want to ask is, how much of the problems that we've seen, and the CEO, say, of Takaful Insurance Africa experiences them immediately as brand risk for her company, how much of that is based on the fact that these insurance zones were drawn, I'll just say politely, in sort of a non-scientific method? So next slide, please. So I've been working with a group from the Technical University of Madrid who have some very interesting remote sensing big data people. And we've taken on this task of how can we do this better? What's being shown here on this graph, the different color areas are 14 insurance zones for the same Marsabit County. And they've actually been statistically optimized. If we can go to the next slide. I'm not going to describe the mathematics here, but basically what we've done, we've taken another page out of finance, and we've designed these zones in order to maximize the probability that a payoff occurs in 1 pixel within a zone, or 1 small area in a zone, when everybody else in that same zone is done. This is called lower tail dependence in finance. So if you have 10 assets in your portfolio, you want to make sure they don't all crash at the same time. So people who are trying to manage a financial portfolio try to minimize tail dependence. What we realized is with index insurance, what we want to do within an insurance zone, we want to maximize lower tail dependence. Okay, we want to make sure that all of the little spots that are within any of these colored zones actually do this. So this is what we work through. It's an extremely complex problem. Just to give you an idea, there are over 9 million pixels of 250 meters by 250 meters in Marsabit County. We have data for over 20 years. We have 24 observations a year. So you start multiplying those numbers together. And the statistical data problem is to define pixels, sifting through millions and millions and literally millions of observations. So my colleagues at the Spanish University had a very clever way of doing this. So the zones that you see there in the map are ones that we restricted ourselves. If we only have 14 insurance zones, what are the insurance zones that actually basically are minimizing the probability of negative basis risk events? So that's a much more scientific approach to going at this problem. So next slide, please. And I'll skip over this. And the real question we want to ask, so next slide, please. The next question we want to ask is, great, we can do this, but does it really matter? Okay, how much does it matter to quality of insurance if we use these optimized zones as opposed to the existing zones? So what you see here, again, these are the existing insurance zones. All the little dots on there are actually households that were surveyed starting in 2010 as part of the original IBLI research design that Chris talked about. Those households were surveyed over 12 seasons. We have mortality data on each of them. So using this data, we can now look backwards and say, what was the expected level of economic well-being of these households without insurance? What would have been their expected level of economic well-being if they had insurance based on the existing 14 zones. And then we can say, what would have been their expected level of well-being if they had an insurance contract based on the statistically optimized zone? Okay, so that's what we want to do. And we're asking, what's the gain using the same index? But what's the gain if you simply improve and rationalize and put a scientific foundation underneath the definition of the insurance zone? So next slide, please. So let's just focus on the orange bars. These are measures of the relative insurance benefit that can be achieved by, on the left side, the existing insurance zones, the 14, and on the right side is the optimized insurance zones. So what you might notice is the existing insurance zones only achieve about 13% of the potential insurance value that's out there. Now that's better than zero. So in other words, the existing contract passes a minimum quality standard, but there's a lot of space for improvement. So the right bar shows that if we simply restrict ourselves to 14 insurance zones, but redefine them as in a way that is statistically sensible in terms of maximizing this lower tail dependence, we can more than double the insurance value from the pastoralist perspective. So we move from only getting 13% of the insurance value to getting over 27% of that insurance value. So next slide, please. The next thing we did, and this starts to look a little like a hodgepodge, but we asked ourselves, well, why do we have 14 insurance zones anyway? Well, why don't we expand the number of insurance zones? So we explored this. This again was a lot of computer crunching time here, but it turns out you can actually move the needle even further in Marsabit using this data if you move to 35 insurance zones. Beyond that, actually the relationship begins to deteriorate. We could talk about that. That has, I think, to do with the complexity of pastoralism. So these are still fairly large geographic areas. But if we go to the next slide, please. What we see, that third bar shows that then we can move to roughly 37% of the potential insurance value if, in fact, we don't restrict ourselves just to 14 zones, which is kind of an ad hoc assumption anyway. Then notice what we've done. Using exactly the same index, using the same household experience, we've tripled the value of insurance to the clients. And this takes into account the prices of these contracts are slightly different. That is worked into the analysis here. We've tripled the value of the insurance simply by going to zones that are much more homogeneous, and so that the experience of people living in these optimized zones is much better captured by the average index and experience within their zones. So this, to me, is absolutely huge. When Chris, Andrew Mude, Pin, and I sat down and worked out our methods, we did the best we could. But what we're seeing is that sort of taking advantage of more advanced remote sensing techniques, some newer ideas out of finance, we can actually make a lot better. And I think as we think about Drive, and I've started conversations with the people at ZEPRI and Acre Africa and the World Bank on Drive, I think there's some huge lessons here about how we actually move forward as Italy expands across the map, as Chris showed us. So I would like to make one final point. If we could go to the next slide, please. So, no, skip that one, please. So one more. Okay. So as you've noticed, right, the best we've done right now is about a third of the potential benefit of insurance, 37%. That's pretty good, right? It's a tripling improvement of where we have been. So the future looks brighter and sunnier, so to speak, despite the clouds of climate change, or maybe the lack of clouds from climate change. But that's still not very good, right? I mean, there's still a lot of headspace for improvement. So I just want to mention what we've implemented in Tanzania and Mozambique, and I know Acre Africa has become interested in this approach as well, which is trying to embrace the intrinsic imperfection of index insurance. We know by definition, we know by definition that index insurance will be imperfect. That's why it's implementable. But what we did in these other countries is we said, we can actually use the kind of data, if we have data on the ground, then we can actually calculate the probability that the index will be wrong. I won't bother trying to explain this picture for you. You can find it on my website somewhere if anyone's interested in terms of going into this. But what we did is we set up an audit-based mechanism in Tanzania and Mozambique for maize farmers. It was originally an SMS-based system where farmers were told about 15, 20 days before harvest whether or not they would get a payment based on a remote sensing prediction of yield losses. And then they could SMS back to the computer saying, you know, your satellite is wrong. Our yields are below the trigger value. And if you don't believe me, come and see for yourself. So we put that into action. It was rolled into a contract. It was blessed by the insurance industry, and it raised the premium a little bit, but it has a tremendously huge impact on the quality of the insurance, because when the satellite-based index is wrong, then the contract required the insurance company to do a crop cut audit at that point. And we could do the same thing in livestock insurance. So next slide, please. That ugly diagram in the left, I'm not going to try to explain to you, but that's actually each of those dots there on the diagram is actually a loss experience of a particular village or community within the Marsabit area. And the red line is showing the kind of payouts they would have gotten. The horizontal axis there is actually the NDVI signal. And as you can see, a lot of those dots lie well above the red line, which means their actual mortality experience was substantially higher than what was predicted based on NDVI. That is, this is even when we've optimized and made better insurance zone. So it turns out the World Bank was involved, I believe, with a IBLI type contract in Mongolia, which was actually based on late season mortality surveys. I think, so I've been talking with Takaful Insurance Africa. I would love to talk to the Drive people as well about the possibility of figuring out how can we do an audit when our indexes are wrong. And we're going to know they're going to be wrong. And so instead of pretending that they're not going to be wrong, let's see if we can come up with an audit rule. So I was at the International Livestock Research Institute a couple of weeks ago, and I was talking to a couple of our colleagues who are from Marsabit and Samburu County about how you could actually audit livestock deaths sort of slow after the fact. And I think there's a number of really interesting ways to do that, going from using smartphones to using drones, et cetera. Again, we could talk more about that, but I think the message I really want to leave with you is that, number one, there's a lot of improvement we can do based on improved indices. Number two, as I've tried to show you with most of my comments today, if we take a more rigorous statistical approach to designing insurance zones, we can have huge impacts on the insurance. And finally, until we get it better, we certainly have the possibility to consider audit-based mechanisms to provide greater security to the people we're trying to help, and really nail down and increase the kind of benefits that Chris alluded to, and Carlene, I think, is now going to check. So next slide, please. So these are just some of the these are the key papers that carry some of the issues that I mentioned. Chris was too humble. I'll mention the last item there, Jensen et al. This is a book which the old people have written, if you will, on the history of IBLI. So this is coming out in a few months from now from Cambridge University Press. And it actually tells this history, this story, summarizes the evolution. So since Q is interested in history, this will be your primer, if you will, on the history of index-based livestock insurance. So I look forward to further discussion. I hope you found my comments or ideas for moving forward helpful here as we try to build on these efforts to do index-based livestock insurance. So thank you very much.
Thank you so much, Michael. It was, again, very, very rich. We'll open the floor now to Caroline Morsenk. Over to you.
Thank you very much, Q, and thank you, Chris and Michael, for your presentations. And it's great to see so many of the collaborators that we know from different places attending this session. So what I'll be talking about is a review of the literature in terms of what we know about the impacts of index insurance on household welfare. As you've already heard, some of those lessons in terms of impact come from the IBLI program, but there is a range of other studies that have been done also around index insurance for crop that show impacts on household welfare. What I want to alert to, and this is joint work with John Plevin from the World Bank Disaster Risk Financing and Insurance Program. And what I want to stress here is that with the empirical evidence that we have here, the questions that we'll be speaking about here in terms of empirical evidence is really focused on household welfare. At the end of my presentation, I'll also briefly speak about other questions surrounding welfare at higher aggregation levels of index insurance that we might and also should be thinking about. Next slide, please. So households, as we have heard from Q and from Lara, households in low-income countries remain vulnerable to aggregate shocks such as droughts, floods, and natural disasters. And as Q has mentioned, this is the case despite the fact that they are actually using a variety of risk management strategies, and those incorporate informal risk-sharing strategies as well. But the problem is that with aggregate shocks, these informal risk-sharing strategies don't work because people are affected in the same direction at the same time, leaving them vulnerable to these shocks. And why these shocks are so important to address is, first of all, that they threaten the short-run consumption of these households. So they have impacts on nutrition. People sell productive assets to cope with shocks, and sometimes people also take children out of school. But recent evidence that has been coming up over the last years also shows that kids who in their youth were exposed to these aggregate shocks experience long-run impacts on indicators of poverty. For example, people who are exposed to these aggregate shocks, who are not capable of dealing with them, actually end up being shorter, having more health problems later in life, having higher likelihood of being disabled, being more likely to be in poverty, and also their human capital accumulation or their education levels are lower, which basically, next please, implies that we need tools to address the impact of these shocks. And as we've discussed here, index insurance is potentially one of the risk management tools that can help achieve this. And when we think about how index insurance contributes to welfare, we tend to think about these two dimensions. On the one hand, if shocks occur, claim payments are provided so that people don't experience these severe drops in consumption that have these extreme long-run impacts. And on the other hand, we also tend to think about insurance hypothetically as a way for people to have more peace of mind so that they feel freer to make productive decisions that enhance their welfare. And if we think about traditional indemnity insurances, we have not been able to achieve that we roll out such kind of indemnity insurance against aggregate shocks at large scale. And index insurance, because it reduces transaction costs, but also provides a solution to address issues with moral hazard and adverse selection that indemnity insurance is faced with, index insurance potentially provides a solution to these problems. But all of that, as Chris and Michael have stressed, is going to be conditional on the product quality of these products. And that's what Michael spoke about. And particularly a big problem here is basis risk. but it's also going to depend on how these programs are implemented. So is access actually created to those who are most in need? Are claim payments actually provided at the moments when shocks are experienced so that people can actually benefit from these claim payments? And are we able to offer products that, from the perspective of the most vulnerable population, are actually affordable? Next. That's why in this work, in this paper, what John and I do is we think through conceptually what impacts index can have on household welfare. Then we look at the empirical evidence to see what that actually tells us, with the connotation that a lot of the questions that we might be interested in just have not been able to be answered because we didn't have the data and the research designs to actually address those. And then the next question, what does this imply for policy and for program design? Next. So one important takeaway when we think about the welfare outcomes of index insurance for households is that we shouldn't be looking at take-up. And that while actually, in fact, take-up is typically the most commonly used measure of success of an index insurance program. And take-up is easy to collect rigorously based on administrative data. But take-up is only a good indicator of welfare improvements under very strict conditions that index insurance and the target population that we are talking about simply do not meet. Take-up would only be informative if we would be talking about an actuarially fair indemnity insurance product where consumers are actually well informed and are willing to pay for the insurance. Next, please. If we then look at index insurance, we know that that product and its target population do not meet these criteria. So it's not the case that index insurance has no basis risk. As soon as there is basis risk, take-up does not necessarily mean a welfare improvement, as Chris and Michael have addressed. Next, please. We also know that we really shouldn't be assuming that our potential consumers are understanding all the bits and pieces of these index insurance products. First of all, take-up we should only be using if people completely understand all the risks that are involved, but would also know exactly what the basis risk is for them. And we, as policymakers, researchers, and insurers, don't even have a good sense of what basis risk is. So definitely our potential consumers do not know. And next, we would need to have products that are actually fair. And that, in fact, sometimes, next please, is the case. So what we can conclude from this is that using take-up as a proxy of the quality of index programs is not helpful. It can even lead to distorted incentives when donors and governments are going to use take-up as a metric of the quality and the success of a program, leading to distorted incentives, for example, by misrepresenting take-up, or it may even lead to so-called fake beneficiaries who exist on paper, but who don't really exist in reality. But that doesn't mean that take-up can't help us to understand some of the welfare components of index insurance products. Next, please. Next. So what I'm showing you here is the use of take-up, but then in terms of the study of how helpful premium subsidies are to understand take-up. So what I'm showing you here in the left column is a whole list of studies that have investigated the effect of premium subsidies or premium discounts on take-up of index insurance products. And you can see here, this has been done for a range of countries. And then you see in the before last column, the level of discount. And then you see after premium subsidies have been provided, what happens to the take-up of products. And what we can see here is that there are actually large and consistent positive effects of premium subsidies on take-up for a majority of studies, but also not for all, which also points to the fact that if indeed there are premium subsidies provided, such as the Casaburi and back please. The Casaburi and Willis study, we see that actually premium subsidies had no big impact, which should raise questions for us about the quality of this product or other constraints that people may have faced in terms of take-up. Next, please. Then, as Michael and Chris have both expressed, studying basis risk and take-up is important, and also studying basis risk is important for welfare. And as mentioned, measuring basis risk requires us to structurally collect data on household losses. And to date, we only have one study that has structurally done this at large scale by collecting data on herd losses for the IBLI program. And there, the IBLI product is actually able to reduce exposure to the covariate or the aggregate risk components of the risk faced by pastoralists by an average of 63%. But their study also shows of all the risk to their assets that these herders are exposed to, the IBLI index insurance, even though it takes out the covariate component of risk, still 69% of the risk that pastoralists face due to also idiosyncratic and other sources of risk still remains. What this study also shows is that before careful efforts were made to explain basis risk, consumers appeared unaware of basis risk. So there was no relationship between the degree of basis risk and the take-up of these products. Only after explicit education about basis risk did basis risk become negatively correlated with demand as it should, showing that informing potential consumers about basis risk is a critical component for them to make welfare-enhancing take-up decisions around this product. And two other studies which are actually based on a rainfall index insurance, where we know now in terms of product quality, that's not a desired product, but we can learn things from these studies. For example, what we can see the study by Ruth Hill and co-authors shows that if farmers were located at a very short distance from a rainfall gauge, where we know that basis risk is low, they are actually 4 times as sensitive to the price of the product than when farmers are located 12 kilometers away. So if, as insurers and policymakers, we are thinking about increasing welfare-enhancing take-up, we know from these studies that focusing on minimizing basis risk is actually a critical component also to create a situation where consumers are willing to pay. Next slide, please. Then creating consumer understanding about index insurance is necessary, but not necessarily sufficient to create welfare for households. So we know that many of these farmers and pastoralists are not financially literate and also have low education levels. Next, please. And many interventions that actually try to educate consumers do not necessarily lead to increases of take-up. Next, please. Next. Next. So what we can see here is that out of a number of interventions that have been tried, next please, to educate consumers, we see that in a lot of cases, actually, there's no increase in take-up resulting from these additional education efforts. And maybe that is as it should, because it's not sure that these efforts were actually related to products that were high quality. We do see increases in take-up of a very intense consumer education program in the study by Gaurav. And in joint work that I have with Glenn Harrison, we also show by using different types of interventions from the field that aim to inform people better about index insurance, that actually these interventions may increase knowledge, and even may increase purchase, but actually do not necessarily lead to welfare. What these interventions do is make people more sensitive to price, to quality, but in the end, people over-purchase this product, and this does not increase welfare. Next slide, please. If we then look at the impacts that I mentioned earlier, both the impacts after shocks occur, and in the next slide, we'll talk about impacts on people's behaviors, we do see that index insurance has potential to maintain production and income levels, to reduce distressed livestock sales, to minimize herd losses, to reduce the cutting of consumption, and to lower child labor. Next. But all of these results were based on the index-based livestock insurance in Ethiopia and Kenya. And why is that the case? Because this was the only study where we have been capable of collecting data over long periods of time to be able to draw these kinds of conclusions. And we also need to investigate, as someone in the chat, Ian has also mentioned, we'd also need to investigate the similar types of impacts for a whole range of index insurance products to draw rigorous and large-scale results that can be generalized around this. And what should be mentioned, even though these outcomes are helpful, what we should also keep in mind that many of the people, the pastoralists, particularly in the pastoralist areas, if we think about their dire circumstances right now, they are at the absolute subsistence. And even if we do not find these kinds of impacts materialize, it might just mean that people are already at subsistence, can't further reduce food consumption or herd size. Next, please. And then we have what I mentioned at the start. There is this impact. People, due to insurance, we hope that people experience a peace of mind from insurance, and that could actually set them on a path of making more productive investments. Farmers may be risk averse and reluctant to invest, and through index insurance, they may be incentivized because they now have the feeling that they're better protected to invest in productive activities. And here's a whole list of impacts that have been found. And this is both for the index-based livestock insurance in Ethiopia and Kenya, but also for several index-based crop insurance programs where we see that individuals are investing more. Next, please. But a note of caution should be made here. What we should be tracking is also if over time, these investments continue to be made, because we all know that people may take up insurance, have a sense that they are protected, but if they're not well informed about basis risk, they may have the insurance, they may choose to invest, and they may experience a loss, but then due to basis risk, they do not receive a claim payment. So we should use these outcomes with care. So to conclude, a sustainable and gradually expanding insurance market can only be achieved if products truly generate welfare and incentivize people to purchase insurance continuously over time. And to be able to create products that have these effects, we must go beyond data collection on take-up and also collect data on these indicators that I just discussed, but also structurally invest in studying both product and infrastructure quality. We, as insurers, we should think about investing in consumer education, product quality, and the minimization of basis risk. And we should be monitoring consumer understanding, satisfaction, and also basis risk. Next, please. Then if we want to study the welfare consequences, we need to be measuring a portfolio of welfare measures, some at larger and some at smaller scales, and that would be an optimal research strategy. Next, please. And the gap in data collection on welfare that we've seen for many programs has actually prevented systematic learning about index triggers, products, and product delivery, with the one major exception, the IBLI program. So I'll stop there. Maybe you can go to the next slide, because even though we focus now on household welfare, because that's what studies have been able to focus on, please show the entire slide. There is a number of important questions that have not yet been studied, and several of us are doing research that's now linked to the DRIVE program, but also other index insurance programs that have started to address some of these questions. Over to you, Q.
Thank you so much, Caroline. Again, very rich, very in-depth and stimulating. I'm very mindful of time and very grateful for participants who stayed till the end of the session and posted questions on the chart, as well as those that sent questions in advance. We will not be able to address all the questions. However, if our panelists are willing to stay on for just another 5 minutes, perhaps we could take 1 or 2 questions, if that's all right.
Okay with me.
Fantastic. I think one interesting one which cuts across all the 3 presentations is on the impact of climate change. Given impact of climate change on frequency and severity of climate risks and losses, the ongoing fragility in economic and socioeconomic systems. One participant asked a question on what is the impact of climate change on the sustainability of insurance-based models, or IBLI in particular. Any comments and thoughts from both Caroline and Michael to this question?
Caroline, would you like to go first?
Yes, thank you. So I think indeed, this is a very important question. And I think we have several ways of thinking about it. I think on the one hand, in the context of climate change, if droughts are becoming more frequent, and we have seen from the results of several studies that actually index insurance is an opportunity for technology adoption. So I think that is one really important way to think about when we think about climate adaptation, that we can actually link index insurance to technologies that would be able to incentivize better adaptation to climate change. I think that's a really, really important component here. I think continued work is also necessary on monitoring the trends in the probabilities of these risks, so that we can continue to adapt over time what the index insurance trigger should be and what the nature of the product is. And then I think that there are very important questions around what kind of productive activities are people involved in, and should we be incentivizing them to maintain in these productive activities? And on the one hand, in these ASAL areas, no other productive activities are possible but this livestock herding. On the other hand, if we provide insurance, and this is a productive strategy, to what extent is that the optimal occupation for these herders and their children? And I think that's also a question that in the work that is funded by Michael Carter's, the MRR Innovation Lab that we're doing together with the International Livestock Research Institute, we are addressing these questions. There are also questions around the link between climate change and how it may lead to conflict, which is also something that we will be addressing. Thank you.
And let me just jump in and complement that. So a couple of years ago, the World Bank put out a report called Shockwaves, which was on the impact of climate change on poverty. Sarah Jansen and I did a background paper on that, which was subsequently published, in which we stress tested the IBLI contract to different climate change scenarios. And what we found is that for sort of intermediate climate change scenarios, IBLI actually became increasingly valuable. And that was sort of measured at the impact, what IBLI could do for keeping poverty rates low, as opposed to not having it. But we found in the most severe climate change scenario, in fact, IBLI basically collapsed and the whole economy collapsed. So I think it's important, because as climate stresses become more frequent and more severe, obviously the price of insurance starts to go up. And so if anyone is interested in that work, it's summarized in the Shockwaves book that was put out by the World Bank, or in a paper in Environment and Development Economics, where we actually literally try to take that on. But I also want to amplify what Carlene said. And I was at the World Bank yesterday at the annual conference on development economics, and we had a very robust conversation about how does index insurance fit into kind of a more general adaptation strategy. And the way I ended up putting it in a discussion with Xavier Gine, somebody that works in this area, who's known, I think, to many of us on this call, is there's sort of a chicken and the egg problem, right? If people are going to adapt. So for example, if you're thinking about, I had a project that never worked in the Dominican Republic where we had small scale farmers who were dependent on natural pasture land, sort of like in northern Kenya, but not at all the same agroecology. And in order to stabilize their livelihoods, the notion was they really needed to invest in some water retention, sort of small dams and some small scale irrigation. The problem was, of course, no bank wanted to lend to them because they were highly risky. And so what we tried to do was design an index contract that would sort of meet the farmers where they were, but then in combination with the rest of the financial system would start to open up resources for them so that they could begin to make those kind of adaptation sorts of investments. So I think we have to be real careful here. As Xavier Gine was saying, you don't want it. You want to think about index insurance as locking people into something that's eventually going to be a non-starter. And that's kind of what our stress testing showed, that at some point that collapses. So one needs to think about, I think, index insurance as a tool that can sort of break this cycle of, gee, I'd like to invest to get out of this, but I don't have any bank money or my own money to move on. And that's where I think interlinking credit and insurance opportunities together potentially become really, really important. But that's very much kind of a frontier. I know that's part of the thinking around the DRIVE program as well, but I think it's something we need to be perhaps a little more intentional about. Thank you.
If I can maybe just quickly jump in, one other part that Caroline briefly mentioned, but one other part of the prospective use of index insurance like IBLI in response to changing climate is to help facilitate livelihood transitions. So Caroline referred to some of the evidence on, for example, investment in children's education and avoidance of child labor. I mean, to enable people in these areas where there just aren't very active labor markets offering remunerative employment, to enable them to acquire enough education that they can move to towns and more reliable livelihoods that are less vulnerable to climate shocks. It requires households making a rather risky choice to put their kids in school rather than hurting their animals. Jen Cisse work showed, for example, that a natural explanation for what it seems overstocking is to maximize household resilience in the face of uninsured drought risk. But when you have a larger herd, that means you need more herders, and those are commonly children. So insofar as index-based livestock insurance enables households to sensibly reduce precautionary savings on the hoof, which is precisely what we seem to see in the Kenya data, we may also be facilitating people transitioning livelihoods at generational scale by investing in children's education, relaxing the demand for child labor and herding, and thereby enabling people to transition out of a sector intentionally and slowly, rather than being cast out of this sector just by the sheer shock force of a drought. Thanks.
Thanks so much for those remarks and very well compelling responses to that question. I'm afraid we won't be able to take any further questions, but we will attempt to send out written responses. We'll curate all the questions that were received through the chats and those that were sent in advance, and circulate some responses to the extent possible for all participants to take the discussions further. From the closing remarks or the responses to that last question, I think we can conclude on this note that really index-based insurance is not an end in itself. It is a means to an end, and that ranges from transitioning pastoralists or households from some of the most at-risk livelihoods, how the program or products can be used to address other broader socio-economic welfare benefits to households, how they sit within the broader financial systems within countries and different contexts. We're excited that the next 3 webinars will indeed be looking deeper into some of these issues. The next one is on financial products. Later on, we'll be looking at this impact from across the 3 layers, meso, micro, and macro, which I've seen questions in the chat speaking to already. And the last one will be looking at technology. So please watch out for updates on this. We'd love to stay engaged. Write to us through the Financial Protection Forum. And again, we will try and make responses from our participants, our panelists, accessible to all. Thank you once again for your time and enjoy the rest of the day wherever you are. Goodbye for now, colleagues.
Bye-bye.
Thank you.
Thank you.
Bye.
Bye-bye.
Thank you. Bye-bye.
Thank you.